Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to look at shopping centres, oil and banks. There's loads going on. I reckon there's over 30 FTSE 100 firms due to report in the next week alone, plus we have the latest interest rate decision from the US Federal Reserve on Wednesday the 27th. But these three themes stand out for me because we've interim results coming up from, in order, Real Estate Investment Trust, or REIT, Hammerson on Monday the 25th, oil giant BP on Tuesday the 26th, and high street bank Lloyds on Thursday the 28th. So let's get going with Hammerson. This is an important one, as the firm is one of four big commercial real estate players in the FTSE 100, and this is a sector that's been in the news of late following the suspension of some property funds earlier this month. Hammerson is a retail specialist with 11 shopping centres and 21 retail parks in the UK, as well as 10 plum sites in France, with tenants ranging from Topshop to Boots and Nando's to Byron. So it'll be interesting to see if the firm has any take on whether Brexit is making any difference to retail spending, their tenants and their properties. The stock market's clearly worried about a downturn, as Hammerson's shares have been, well, hammered since the 23rd of June. There's every chance, I would guess, that management will say it's too early to tell when it comes to the implications of the Leave vote, but there are some other key numbers that you can check out besides the commentary. And they are net asset value, or NAV per share. This was 710 pence at the end of last year, and that compares to a current share price of about 530. The occupancy rate, which was 97.7% at the end of last year, and like-for-like rental growth is the other thing to look at, that was 2.3% last year. NAV is probably the biggie. This next chart shows NAV per share at Hammerson since 2005, and the big dip reflects the great financial crisis, though also bear in mind the firm raised cash in 2009 and 2014, increasing the share count. Questions to ask are how bad any downturn will be, if it comes, relative to the last one, and how much of this is already reflected in the share price. Now next up is oil major BP and its first half numbers on the 26th. It seems like a long time ago since the market was fretting about oil going below $30 a barrel, and a recovery to nearly 50 plus the pound's post-referendum plunge against the dollar have put a spring in BP's shares. They've recovered nicely and done relatively well since the Brexit vote. Now this is a huge company, it's very complex and the numbers can be a bit messy, but the figures to watch are as follows. Their headline replacement cost profit. In Q1, BP made a $485 million loss, but a higher oil price and lower costs should have helped since. Watch for oil production, that fell 1.1% like for like in Q1, and also look at the balance sheet where net gearing or debt to equity was 30% at the top end of management's range. And then we get to the dividend. It's been running at 10 US cents a quarter, 6.92p in Q1, using a sterling dollar cross rate of nearly 145. The pound's weakened since then, and a higher oil price and lower dollar could help earnings and therefore dividend cover, providing those trends remain in place. Finally, we come to Lloyds, interims on the 28th. Its shares have been hit hard by, as yet, unproven fears of a recession in the wake of the Brexit vote, and in particular that any housing downturn would hurt Lloyds through its exposure to the mortgage market. Remember that at the first half stage, an underlying profit of £2.1 billion easily beat analyst forecasts. Net asset value per share again, NAV, rose to 55.2p, pretty much where the shares are now. So they're two key benchmarks. But also keep an eye on any other one-offs for PPI or legacy and legal issues, and the all-important dividend. Lloyds paid 0.5p a share at the interim stage last year, and then followed up with a 1.7p final and a half p special. Analysts are looking for a jump to around 4.4 pence a share in total this year, enough for an 80% yield, a figure that's higher than the stock's forward PE of 7 using consensus analyst forecasts. Now that's pretty unusual, yield higher than the PE, so either the stock's dirt cheap and the market's wrong, the analysts' forecasts are optimistic and the market's right, or somewhere in between. So let's see what clues we get from the interims and any comments on the broader trading and the UK economy from Lloyds boss Antonio Horta-Othario. So thank you for watching, and I look forward to seeing you next time.